All right, so you want to know more about the state of venture capital in 2024. You sent over a ton of data reports, analysis, the whole shebang.
Yeah, it's quite a bit.
Let's dive right in and see what we can find, shall we?
Sounds good to me.
All right, so the big kahuna today is this Q4 2024 PitchBook-NVCA Venture Monitor.
Right?
It's a pretty hefty report, I gotta say, with some pretty big names sponsoring it. JP Morgan, Deloitte, and a few more. Just to give you a taste, one thing that really stood out to me was that those mega deals, the ones we always hear about in the news, they only made up like 3.6% of total exits last year.
Yeah,
Yeah.
that's right. But here's the catch. Those deals accounted for nearly 80% of the total exit value.
Whoa, okay. That's a pretty big gap. Talk about the 1%, huh? And then there's AI. The report says it pulled in almost half of all deal value in 2024. Was it all just hype, though? I'm curious to
Yeah.
get your take on that.
Well, I think the first thing we need to do is zoom out and look at the big picture. 2024 was definitely a year of recovery for VC, but it was a cautious one. We saw activity climb past pre-pandemic levels, which is encouraging, but we're still nowhere near the crazy boom times we saw during the zero interest rate policy era.
So basically, things are better, but not back to party like it's 2021 levels.
Exactly. The report actually uses the term liquidity crunch, which basically means there's a lot of value trapped in private companies right now. Remember all that money flooding into startups, especially during the pandemic?
Yeah.
Well, a lot of those investments haven't matured yet. We're just not seeing enough exits, especially IPOs.
So it's like you're an investor sitting on a pile of gold, but you can't actually spend it until there's an exit, like an IPO or a sale.
That's a great way to put it. And that pent-up demand for liquidity is having a ripple effect throughout the whole VC landscape. It affects how deals are made, how new funds are raised, everything.
And that brings us back to those mega deals, right? It seems like while the total value of deals went up, the actual number of deals didn't really increase all that much. Those huge deals, especially in AI, really skewed the numbers, didn't they?
Yeah, definitely. The top 5 deals in Q4 2024 were all AI companies. Databricks, OpenAI, xAI, Waymo, and Anthropic. Every single one was massive, which of course pushed up the total deal value. So yeah, there was recovery, but it was really driven by what was happening at the very, very top.
It's interesting, though, the report also said early stage deal activity hit a high in 2024. So are investors still willing to bet on brand new companies, but maybe getting a little more cautious when it comes to the later stages? It looks like those lead stage deals actually declined for the third year in a row. What's the story there?
Well, I think it makes sense when you think about those exit challenges we just talked about. If you're an investor and you're not sure when you'll be able to cash out on your later stage investments, you're going to be a lot more careful about where you put your money, right? Early stage deals need less capital upfront, and the potential upside is still huge. So it's a way to manage risk while still participating in potentially high growth areas.
Makes sense. And then there's this other data point that really stood out. The median time between funding rounds is actually getting longer. For Series C and later stage companies, it's now over 2 years. Even those established unicorns, they haven't raised new capital in 2 years. What do you think all this tells us about, like investor expectations and how startups are approaching capital efficiency these days?
I think it's a pretty clear sign that those easy money days are over. Investors are demanding more from the companies they back: sustainable growth, clear paths to profitability, a real laser focus on using capital wisely.
So even if you're a billion-dollar unicorn, you can't just waltz in and expect another billion-dollar check without proving you can actually get stuff done.
Exactly. Investors are taking a much harder look at business models, unit economics, the whole 9 yards. They're not just chasing the hype anymore.
Speaking of hype, let's talk about AI. It was definitely the rock star of 2024, grabbing almost half of all the deal value. It felt like everyone suddenly decided that AI was the golden ticket to riches. What are your thoughts on all that?
Well, there's no question AI had a major impact on the VC world. All that intense focus definitely pushed up valuations and deal sizes. There was a definite sense of FOMO, a fear of missing out that drove a lot of the investment activity.
But was it all justified? Is AI really a game changer, or was it all just a bunch of hot air?
That's the billion-dollar question, isn't it? AI has incredible potential, and we're already seeing it changing things in a lot of industries. But I do think the hype got a little ahead of reality in some cases. Valuations got inflated, and some companies were just riding the AI wave without having the tech or the business model to back it up.
Yeah, the report even mentions concerns about an AI bubble. So maybe not everything that shines is gold, huh?
We definitely need to be cautious. Not every AI company is going to be a success story. The trick is going to be figuring out which ones are the real innovators and which ones are just, well, posers. That's where good due diligence and a deep understanding of the technology really come into play.
Right, right. So you're interested in mention the listener's city or region if known from their sources, right? Well, one thing the report points out is that VC investment is still really concentrated in those big hubs, the Bay Area, New York, Los Angeles. It seems like other areas are having a tougher time attracting capital. What do you think that means for someone like you who's outside those major hubs?
It's a real challenge, for sure. Those major hubs have this critical mass of talent, resources, and connections that is really hard to replicate. But it does make you wonder if we're missing out on some amazing innovations happening in other parts of the country.
So how do you navigate that? What advice would you give yourself, knowing what we've talked about so far?
I think it comes down to being strategic. You have to
Yeah.
build a strong network, really highlight what makes your company or your region special, and connect with investors who are specifically looking for opportunities outside those traditional hotspots. It's definitely more work to get noticed, but there are definitely investors out there who are searching for those hidden gems.
Great advice. Okay, let's switch gears a bit and talk about the investors themselves. The report looks at different types of investors like corporate venture capital, CVC, crossover investors, and the rise of venture debt. Let's start with the CVCs. They were still a big force in 2024, particularly in AI, weren't they?
Absolutely. CVCs were involved in a lot of those mega deals we were talking about earlier. They have the resources and the strategic reasons to make those big bets, especially in areas like AI, where it could really impact their core business.
Makes sense. But what about crossover investors, those hedge funds and mutual funds? They actually pulled back from VC in 2024. That seems a little weird, right? You'd think they'd be the ones stepping in to fill the gap when traditional VCs are being more careful.
It's counterintuitive, but it really comes down to their investment goals. Crossover investors are usually more focused on short-term returns and quick liquidity. With the IPO market being so quiet, they're just not as interested in tying up their money in those late-stage private companies.
So they're looking for faster wins, which they're just not seeing in the current VC market.
Exactly. Which brings us to another interesting trend, the explosion of venture debt in 2024.
Yeah, that definitely caught my attention too. Is that a good thing or a bad thing?
Well, it's kind of a sign of the times. With equity funding getting harder to find, companies are turning to venture debt as another option. It can be a good way to bridge funding gaps, extend their runway, and avoid giving up more equity in those dilutive funding rounds.
Right, but it's not exactly free money, is it?
Oh, definitely not. Venture debt comes with its own set of risks and costs. You're still taking on debt, and you have to be able to pay it back.
And one more thing that I found really interesting, the report says venture debt is starting to follow those same trends we see in equity investments. It's flowing heavily into AI and later stage companies.
Yeah.
What's your take on that? Is that a sign of confidence in the future of AI or maybe a bit of desperation in a tight funding market?
It's probably a little bit of both, to be honest. Lenders are seeing the potential in AI, so they're more willing to provide that debt financing to help those companies grow. But it also shows how those later stage companies, especially in hot areas like AI, are having to get creative with their financing when equity gets scarce.
It's like a double-edged sword then. Venture debt can be a lifeline, but it also has its downsides. Okay, we've covered a lot of ground already, but there's still more to unpack. We need to talk about the fundraising challenges that VC firms are facing themselves. Let's dive into that after a quick break.
Sounds good.
Okay, so before the break, we were digging into how venture debt is really taking off, especially for AI and those later stage companies. But now let's turn the tables a bit and look at the VC firms themselves. Because from what I'm seeing, it looks like 2024 wasn't exactly a banner year for them when it came to raising capital.
Yeah, that's definitely true. VC fundraising actually dropped all the way back down to pre-pandemic levels last year.
Really? Wow. So what was going on there? What were the big things dragging them down?
Well, a big part of it is that the people who invest in VC funds, the limited partners or LPs, they were dealing with a liquidity crunch of their own. Remember all that unrealized value we talked about, all those gains locked up in private
Oh,
companies?
yeah.
Well, that lack of exits really put a damper on LPs' ability to commit to new funds.
So it's like a domino effect.
Yeah.
Fewer exits mean less cash flowing back to the LPs, and that makes them hesitant to put more money into new funds.
Exactly. It was a tough environment all around, but especially for those emerging managers, the newer firms trying to break into the VC game.
Yeah, the report actually highlighted that. It seems like those established big-name firms were the ones raking in most of the LP commitments last year. It's like it's getting even harder for new firms to get a foot in the door, join the club.
I think that's a fair assessment. When things are uncertain, LPs tend to go for stability and predictability. So naturally, they're drawn to those firms with a proven track record, the ones that have weathered storms before and consistently made money.
Right, right. From their perspective, it makes total sense. But doesn't that also create a kind of barrier to innovation? Like if those emerging managers can't raise capital, aren't we potentially missing out on some fresh ideas and new approaches?
That's a valid point. A healthy VC ecosystem needs a diverse range of ideas and investment strategies. But when investors get nervous, they tend to stick with what they know.
Yeah, it's human nature, right? And speaking of nervous, the report wasn't exactly rosy when it came to those emerging managers. Remember all those funds launched during those boom years back in 2020 to 2022? Well, a lot of them are finding it incredibly tough to get commitments for their next fund.
Yeah, talk about bad timing. They launched when valuations were sky high and everyone was throwing money around. The market has totally shifted since then, and many of those newer funds just haven't had the chance to prove themselves in a tougher environment.
So they're stuck in this catch-22, right? They need a solid track record to get those LPs on board, yeah, but they need LP money to build that track record in the first place.
Exactly. And that's a big reason why we're seeing fewer first-time fundraising efforts, both in terms of the number of funds and the total capital raised.
It's like a bottleneck in the whole system, right?
Yeah.
That limited liquidity squeezes fundraising, which then limits the money available for new investments.
Yeah, it's a vicious cycle. And the report really paints a stark picture of this funding crunch. It makes you wonder, how will this all affect the flow of capital and innovation going forward?
Big questions, for sure. But before we get too deep into the existential stuff, let's address the elephant in the room: exits. We've touched on them throughout this whole deep dive, but we need to spend some time really unpacking this because, honestly, without exits, the entire VC model just crumbles, right?
Absolutely. Exits are the lifeblood of VC. It's how venture capitalists return money to their LPs, and ultimately, it's how they measure their success.
So let's take stock of what happened in 2024. The report said exit activity actually ticked up a bit from 2023, but the overall value was still way below pre-pandemic levels.
That's the key point here. There were some positive signs, but we're a long way from a full-blown recovery in the exit market. And that's really fueling all those liquidity concerns we've been talking about.
Right, right. And the report breaks those exits down into a few different buckets: IPOs, M&A, and even secondary sales. Let's start with the IPOs. They were still pretty thin on the ground in 2024, weren't they?
Yeah, unfortunately, the IPO window stayed pretty much shut, which is a huge factor in that liquidity crunch. And even for the companies that did manage to go public, the IPO price often ended up below their last private valuation.
So even when companies did go public, it wasn't always the big payday that investors were hoping for.
Nope. It's a good reminder that the public markets have their own rules, and companies need to be able to justify their valuations even if they've been riding high in the private market.
Right. So if IPOs weren't carrying the weight, that leaves M&A, right?
Yeah,
But even there, it sounds like things were pretty quiet.
that's right. While M&A did make up most of the exits in 2024, a lot of those deals were on the smaller side, not those huge lucrative transactions. They helped clear out some of the backlog of companies looking for an exit, but they didn't deliver those blockbuster returns that investors are chasing.
Yeah, the report used the term low-returning sales to describe some of those M&A deals. Sounds like some companies were practically giving themselves away just to avoid shutting down.
Well, maybe not that extreme, but the lack of good exit options definitely put pressure on some companies. Faced with a tough market, they might have chosen a less than ideal acquisition rather than struggling to stay independent.
So what was behind this sluggish M&A market? What were the big roadblocks?
I think we have to acknowledge the impact of the FTC's tough stance on antitrust. Their increased scrutiny of mergers and acquisitions really created a lot of uncertainty and probably scared off some potential deals.
That makes sense. Companies are going to be hesitant to go through all the hassle and expense of a deal if they're not even sure it'll get approved by the regulators.
Exactly. And remember, the FTC's approach could change under the new administration. The report actually suggested that a more business-friendly FTC chair could make things a lot easier for M&A in 2025.
Now, that would be something to celebrate, both for companies and investors. But even if those regulatory hurdles disappear, there are still other factors at play, right? The overall economy, interest rates, inflation, all those global uncertainties, they can all have a big impact on M&A activity.
Absolutely. Companies are less likely to make those big, risky moves when the future feels so unpredictable, and that uncertainty definitely cast a shadow over the M&A market last year.
So it sounds like the outlook for M&A is a bit of a mixed bag. We'll have to see how all those regulatory and economic pieces fall into place in 2025. But what about secondary sales? The report mentioned they're becoming a more popular way to get some liquidity, but often at the cost of lower valuations. What does that mean for the people involved?
Secondary sales give those early investors and employees a chance to cash out some of their shares, even if the company hasn't gone public or been acquired. It can be a way to unlock some value in a tough market, but it often comes with a catch.
A catch. What do you mean?
Well, those secondary sales usually happen at a discount compared to the company's latest valuation. So sellers get some cash, but they might not be getting the full value of their shares.
So it's a trade-off. Get some money now or hold out for a potentially bigger payout later. That must be a tough call for both sides.
For sure. And it just shows how the lack of those traditional exits is forcing everyone in the VC world to find creative solutions.
Okay, we've spent a lot of time talking about exits, or rather, the lack of them. But I think the main takeaway here is that the exit landscape, just like the rest of the VC world, is in a state of change. Things are shifting quickly, and we're all still trying to figure out what the new normal is going to look like.
I totally agree. And that brings us to the million-dollar question. What's next for venture capital? We've talked about all the challenges, but are there any reasons to be optimistic? Let's dig into that after the break.
Okay, so we've spent the better part of this deep dive really getting into the weeds of venture capital in 2024. We've seen some pretty big hurdles, right? Liquidity crunch, the fundraising bottleneck, the whole exit market being kind of slow. It's a lot to take in, but you sent over some stuff looking ahead to 2025. So is there any light at the end of the tunnel? Is there anything to be optimistic about for the future of VC?
Well, it's not all doom and gloom, that's for sure. The report actually points out a few potential bright spots, things that could shake things up in a good way.
Okay, good. I'm definitely ready for some good news. Give me those bright spots.
Well, for starters, there's a chance we might see a better regulatory environment for M&A. We talked about how the FTC, their scrutiny of mergers and acquisitions created a lot of uncertainty, right? Probably scared off some deals last year.
Yeah.
Well, now that there's a new administration, we might see a change in how the FTC does things. If the new FTC chair is more business-friendly, that could really kickstart M&A activity, especially those mid-sized to larger deals that have been missing lately.
So less red tape, more deals. I like the sound of that. Anything else?
Well, interest rates are another big thing to keep an eye on. Higher rates make it more expensive for companies to borrow money and for funds to raise capital. That's been a real drag on VC. But good news is the Fed's already started cutting rates, and most people think they'll keep doing that. Lower interest rates could really get things moving again, boost investment and maybe lead to more deals overall.
Yeah, I see what you mean. Easier to get money, that helps startups grow, and it makes investors feel more confident. Okay, so we've got some potential wins from both the regulatory side and the big picture economic side. But what about those headwinds? What could hold the VC market back in 2025?
Yeah, you're right. We can't ignore the potential downsides. Geopolitical stuff, and market volatility, those are always wild cards. The world's a pretty unpredictable place right now, and that can make investors nervous, especially when it comes to things like VC that are considered riskier.
I hear you. It seems like every time you turn on the news, there's something new to worry about: politics, trade wars, you name it. Hard to feel good about making those long-term bets when things feel so shaky.
Exactly. And the report acknowledges that,
Yeah.
It's not pretending that the road to recovery is going to be smooth sailing.
So basically, 2025 could go either way. There are forces pushing for growth, but there are also some pretty big challenges to overcome. What are the big questions we should be asking ourselves as we go into the new year?
Well, one of the biggest ones is whether those big exits will finally happen. Will the IPO market open back up? Will we see more strong M&A activity? I think that's what everyone's waiting for, that moment when all that pent-up value finally starts to flow back into the system.
Right. And what about AI? It was a big story in 2024. Will it still be the main driver in 2025, or will investors start looking at other things?
Another good question. AI has huge potential, but we got to be realistic, right? Not every AI company is going to be a winner. The real key is going to be separating the true innovators from those who are just, riding the hype train.
So as we wrap up this deep dive, I'm curious to hear what stood out to you. We covered a ton of ground, looked at the good, the bad, and everything in between in the VC world. What are your big takeaways? What really stuck with you?
Well, one thing that really hit home for me is how interconnected everything is in the VC world. It's like a big web, you know. Exits affect fundraising. Fundraising affects deal making. It all feeds into itself. It's a delicate balance, and when one part of the web gets messed up, it can really shake up the whole system.
Yeah, that makes a lot of sense. It's not just about individual companies or investors. It's about how healthy the entire ecosystem is.
Exactly. And the other thing that really struck me is how important it is to adapt. The VC landscape is constantly changing, and the people who can roll with those changes are the ones who are going to succeed. Whether it's jumping on new technologies, finding new ways to get funding, or looking for opportunities outside the usual places, those who are willing to think outside the box are the ones who will come out on top.
Great points. So, what does all this mean for you listening out there? We've gone through a lot of information about venture capital, but how does it connect to what you're interested in, what you're trying to do? What trends really jumped out at you? And how do you think those trends are going to affect how you approach investing or building your own company in 2025? It's a lot to think about, but that's kind of the point of these deep dives. We give you the data, the insights, and the expert perspective. Now it's your turn to put it all together and figure out what it means for you.
Exactly. And don't forget, this is just the starting point. The VC world never stands still. Keep learning, keep asking questions, and keep exploring. Knowledge is power, especially in a field like this that's always changing.
Couldn't have said it better myself. Thanks for joining us on this deep dive.